Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in Lisbon, Portugal, at PwC's Global Tax Symposium, Europe 2024, where I'm excited to have Matt Ryan back on the podcast. Matt is a London-based international tax partner at PwC and the leader of PwC UK's International Tax and Treasury Network. Matt, welcome back to the podcast.
It's great to be back, Doug. Thank you.
So, Matt, you're a frequent guest on the podcast.
Yeah.
I think this might be 3 or 4. We've been talking about Pillar 2 and other UK developments for a long time. And at least you claim to also be a listener of the podcast. Okay, so my question for you is, does all my American baseball talk at the beginning of these podcasts inspire you as a Brit to watch more baseball?
Absolutely not. That's what skip functionality is for.
Okay, so let's dive into Pillar 2 in the UK. Can you start, Matt, with the summary of where we are on Pillar 2 in the UK and how we've gotten here? Because this has been a journey.
It really has. It's been a journey over a long time. The UK was quick out the doors with draft Pillar 2 legislation, which indeed got revised a number of times before it got implemented. But Pillar 2 is live in the UK. We have the domestic minimum top-up tax and the income inclusion rule in the UK from accounting periods kind of starting on after 31 December 2023. So January 2024 for the majority of people. And we don't have the UTPR yet. We're in the process of continually revising the legislation to incorporate the administrative guidance, and have just recently released a finance bill to do just that.
All right, and we're going to get into some of the details of that finance bill and also learn a little bit more about the UTPR. But there's been quite a bit of media recently, Matt, about the demise of Pillar 2, or that Pillar 2 is in peril as a result of the recent U.S. election results, where President-elect Trump, as well as the Congress controlled by the Republicans. Matt, is the UK going to repeal Pillar 2 now that Trump's in office?
In short, no.
I had a feeling that was the answer.
I think you thought that was going to be the answer. But yeah, the UK, as I said, it was quick to release the draft legislation. It's been going through ensuring that all the UK changes it introduces and the views it gives in terms of guidance are aligned with the inclusive framework thinking. So the UK is a key proactive member of the inclusive framework, to the extent the rest of the inclusive framework decided that as a consequence of Trump they were going to withdraw Pillar 2, the UK would follow suit. But I think we both well know that is that's a pretty firm bet that that's not going to happen.
Yeah, and I will also remind listeners that the UK is no longer an official member of the EU, so obviously not required to follow the directive. So it certainly gives you more flexibility from a tax or from a policy perspective.
That absolutely does, but I think from a political perspective, you need the whole EU to remove the directive, and so that's a long process if that's ever going to happen.
Yeah, and I've been cautioning taxpayers to, just because of some of these discussions and headlines, I believe the way I read those headlines is that the policy of Pillar 2 to be able to create a consistent global tax, minimum tax. The policy of that is now in peril because with the election of Trump, the likelihood of the U.S. enacting Pillar 2 is remote at best. And so without the U.S., and then we'll see what happens with China, India has said that they may. We'll see if they move back from that. But I think it certainly imperils the overall policy perspective that Pascal said on this podcast was the intention. But to your point, like particularly in the EU, to try to remove the directive will be a long, long time. And public companies are still going to have to provide for the tax and then ultimately have to comply with those rules.
Absolutely.
So as we think about compliance, what I wanted to start with is Pillar 2 registration requirements. It took many taxpayers by surprise. Belgium had one of our colleagues, Peter Duray, on the podcast a few episodes back. What has the UK said about taxpayers registering for Pillar 2 in the UK?
So the UK has come out and clarified what needs to happen, but it is very much a lighter touch as compared to Belgium and what we're seeing elsewhere. And so the deadline is also giving companies more time to the 30th of June 2025, essentially 6 months after the start of the rules. But all you really have to do is decide which entity is going to be filing the returns. And the default position is the obligation is on the ultimate parent entity to file the returns. So the expectation is it's the ultimate parent entity registers, just providing some high-level details, the company's name, its address, and contacts at that company. That is pretty much it. And then you get like a Pillar 2 like reference number as a consequence of that. And there's a need also to register for the UK's domestic minimum tax. But again, the overall filing responsibility there sits on the ultimate parent entity, with the possibility that you would nominate another entity in the group to undertake your filing. So, say a US parent with a UK holding company, which is the IIR kind of holdco for the group. The ultimate parent entity has the filing obligation, but they could nominate that UK company to undertake the filings.
And that's also true for the QDMTT.
Yes.
So presumably most non-UK parented multinationals will nominate their UK entity to do the filings for the QDMTT and IAR.
You would think so, but I think at the moment most groups are dealing with these slightly more burdensome other registration requirements that are coming like pre-December and January, February.
Exactly. And there are quite a number of those, which you can find on PwC's Pillar 2 tracker, which is available for everybody on the internet. But a lot to keep track of. Absolutely. There, as we've both been keeping an eye on those registration requirements. So before we turn to the finance bill, what about other compliance requirements? Do we have any insight? Because this is something that, I'm staying very close on as we, build our Pillar 2 engine and compliance grade solution. What do we know, if anything, about the compliance requirements? Do we have any insight on the QDMTT form in the UK and when it may be due?
No, we don't have the precise details of the forms yet, but we do know when they're going to be due, that they're going to be due following the prescribed 18 months following the year end for the first year, and then it's cut back for a shorter period. So that much has been clarified, as well as when the Pillar 2 tax actually has to be paid by, to the extent that you've got any, kind of mirroring those same deadlines.
Okay. And does the UK have any form of estimated payments or anything like that Belgium has?
No, we're like aligned with the kind of OECD deadlines. So payment due when returns due.
Yeah, it's helpful to we have that guidance from the UK, and we'd certainly welcome a lot of that guidance from other jurisdictions to understand exactly what's going to be due and when it's going to be due for taxpayers. Okay, so the UK introduced additional legislation on Pillar 2 with Finance Bill 2024-2025 here at the end of 2024. Before we get into the details, can you remind listeners, please, of just how the legislative process works in the UK? We don't need the full civics lesson that we had on one of our earlier podcasts, but just kind of an overview of
sure. Well, for anyone who listened and didn't skip through that, it wasn't the most complete lesson that I've given on UK process and procedure. So high level, we have a draft finance bill is released, and it has to go through several readings through the House of Commons and the House of Lords before ultimately it's given royal assent and brought into law. And throughout that whole process, changes can be made to the draft legislation.
And how does it work with respect to retroactivity? Because the administrative guidance that the current legislation involves includes the December 2023 administrative guidance, the June 2024. How does that retroactivity potentially apply?
Yeah, sure. So from an overall, rule of law in the UK, it's only retroactive to the extent that it would be brought in after the year ends close. So if we introduce something now, we're in November, that applies from the start of the year, that's not considered to be retroactive. However, there has been an acknowledgement that bringing something in close to the year end could disadvantage taxpayers, and say they've taken the decision that to the extent something is helpful, companies have the option to bring it in from 1 January 2024, or they can just apply the existing rules for 24 and bring it in from 2025. There's certain provisions that just apply from 1 January 25 and a couple that do apply from 1 January 2024, but again, that they would be considered to be not taxpayer unfriendly.
And one of the things that the OECD has told us of the many is that we should be expecting additional administrative guidance potentially before the end of calendar year 2024. I think many of us might expect that that dates could slip if prior precedence is indicative of future results. So as future administrative guidance comes in 2025 as it relates to the QDMTT and the IIR, is that something that can be introduced retroactively? Does it matter if it's a new law or an interpretation like in some jurisdictions?
So on the whole, to the extent that new rules are being introduced through the administrative guidance as opposed to clarifications, which I think we've seen the majority of things are new.
But beauty is in the eye of the beholder.
The beauty is in the eye of the beholder, isn't
on
it?
that one.
But the majority of those, there'll need to be an additional finance bill to bring things in. But what we have seen within this existing finance bill is some of the provisions just follow the OECD administrative guidance, giving powers for specific guidance to be brought in at a later date to effectively clarify what the OECD guidance says, or maybe alter it. We'll have to wait and see.
Yeah, I mean, one of the things that the OECD has been saying for a long time that they were going to bring in the the so-called anti-arbitrage rules from the transitional safe harbor into the full globe rules. Yeah. And that very much feels like not a clarification and new rules.
It does seem that there will be an administrative burden associated with it such that not many people would describe that as taxpayer friendly. What my expectation is that after that administrative guidance is received, there will be an announcement from Treasury that they intend to bring it into legislation. And from the point in time that that announcement is made, that will be the effective date of that legislation, because that's what we've seen with the anti-hybrid arbitrage rules in relation to the country-by-country rules. On the 17th of March this year, we announced that we would follow that legislation. It is in the draft finance bill, and the effective date of that is the 17th of March. So anything that accrues after the 17th of March, you need to adjust for the purposes of your CbCR calculation.
Okay. So what I want to do is go through a sort of selected list of issues and topics that I think will be relevant for listeners related to the Finance Bill 2024 that brought in this administrative guidance into the UK rules. Let's start with the headline, which is the undertaxed profit rule. You now have officially enacted.
Yep. So, not officially enacted yet, because it does need the King's seal of approval.
Thank you.
For it to come in.
That is the other part of the process that we missed there. So we need
that was the royal assent. Okay. The King's seal of approval.
Thank you for reminding this constitutional democratic person of how those rules work.
So it is broadly doing what would one expect. It follows the OECD model rules, and it will apply from accounting periods ending after 31 December 2024, so for the number of people really coming into effect 1 January 2024.
All right. And presumably the UTPR safe harbor, which will protect U.S. multinationals, is included within that.
That is included, yes.
Okay.
Yes.
One of the things that I will just mention, and I don't want to go too deep down this rabbit hole, is that one of the suggestions by the Trump administration, or proposals by the Trump administration, was to reduce the corporate tax rate in the U.S. And I think listeners need to be very mindful that if the Republicans are successful in reducing the corporate tax rate below 21%, that they will no longer qualify for the
UTPR safe harbor.
For the UTPR safe harbor. So caveat.
One would think someone might point that out.
Caveat emptor for U.S. multinationals that are lobbying for that lower rate. Okay, so we can move on from the UTPR. And let's start with, how did the legislation address whether another country's Pillar 2 regime is qualifying? Because whether something is going to qualify, I think, could be a huge both technical and political issue. So what has the UK said about that?
I think the UK has adopted a pragmatic approach here. And so it's essentially saying that if a country comes out and says its rules are qualifying, and they are found to be searched by whatever process is finally adopted by the inclusive framework, which, as you say, we haven't quite heard yet, then that will be the case for the UK rules, and you'll have your QDMTT exemption, or that another country has introduced an income inclusion rule, which means the UK doesn't have to. And they've given authority there, as I mentioned, that administrative guidance can be introduced to clarify which countries are indeed qualifying.
First of all, I'd like to congratulate you, because I think it's the first time that the word pragmatic has been used on a Pillar 2 podcast of mine, Matt. So it's a welcome result. And I think it's just going to be really interesting to see how the entire qualifying process works, and to the extent that the OECD is going to try to put together some form of committee, or I think it would be very helpful for guidance. And I think that the way the UK is adopting it, or is enacting this, I agree. It's pragmatic, and I think most those of us that are very involved in the details of Pillar 2 understand whether something is qualifying or not qualifying. Although there are certainly some things around the edges.
There's some debate there.
Some debate, yeah. certainly around the edges. Okay, let's move to the transitional safe harbor. I mentioned these earlier, the anti-arbitrage rules.
So yeah, I mentioned that earlier. That is being introduced with effect from any amount that accrues after the 17th of March. Adjusting your CbCR calculation. So we have that in rules. But that point is it will not actually be passed into law until 2025. So for provisioning purposes, actually there's no need to adjust the UK your UK QDMTT safe harbour, looking at the CbCR safe harbours. No need to apply the rules for 24. They're just kicking in 25.
Very important point, which is why you corrected me earlier, rightfully so, on whether something is proposed and enacted. And so these rules are not enacted until we have the royal assent. And so, I mean, this is is going to continue to be a challenge for taxpayers that are thinking about their provisions, and then also ultimately thinking about the return filing, because as administrative guidance keeps coming out, and then those rules come out later with the intention to be retroactive, well, obviously those rules have to be incorporated into domestic legislation and then have to officially be enacted. And then companies for public companies aren't going to actually provide for those particular taxes until they're enacted. And so as those cross-accounting periods, taxpayers need to be very mindful of when those things are actually enacted and compared to when they are proposed. And frankly, just a lot to keep track of for taxpayers trying to do this on their own. Okay, sticking with the safe harbor the safe harbor, there was some specific rules with respect to purchase price accounting.
Yeah, so this is giving effect to the June guidance that we had under the main rules. To recap, you have to reverse purchase pricing adjustments unless you don't have the appropriate records, whereas this is bringing in the consistency rule that essentially if those purchase price adjustments are pushed down into the 2023 CbCR report, then you can basically follow that for the purposes of the CbCR calculations, just with that exemption in relation to amortization of goodwill for acquisitions after December 21.
Yeah, I think that's the most common one.
So yeah, it's pretty much exactly what the OECD says. I would note though that this is one of the areas where the draft rules may need to be revised, because the UK hasn't quite got it right, but I expect they will notice this. everyone comments on the draft rules and say it will be clarified, so it's exactly in line with the guidance.
And is there an opportunity to clarify those rules before it goes through royal assent?
Absolutely,
Okay.
yes.
All right. So the other one, and this is, I think we've chatted about this on some of the prior podcasts in the UK. What about cross-border allocation of deferred taxes?
So the UK had taken a different approach on the push down of deferred taxes in terms of just allowing the push down of current taxes with no push down of deferred taxes. We understood that was a consequence of discussions still taking place at the OECD. And to get the use of the word pragmatic in again, the UK has just said we import the administrative guidance such that if there is a subsequent change in the next round of administrative guidance we get next year, then the deferred tax pushdown rules will get revised again. But we are now in line with the OECD guidance with regulatory authority to change the rules if necessary.
Yeah, and what I thought was interesting about this particular piece is that if this effectively gives Treasury sort of regulatory powers to be able to mend this in due course. Is that something relatively common, or is this kind of novel with Pillar 2?
No, it is actually in a number of areas where you've got something that's particularly detailed. One would say, why don't you have reg authority for the entirety of Pillar 2 rules? But where something is particularly detailed, then reg authority is given just to allow it to be changed on an ongoing basis.
All right, so one of the most complex areas, in my view, of all of Pillar 2, and this is saying something, is with respect to the DTL recapture and what was provided in the June 2024 administrative guidance. I mean, this is just incredibly complex and requires taxpayers to frankly track issues. And I know the OECD, I think, was well-intentioned, trying to at least create some sort of process for taxpayers, but still something that not any taxpayers that I'm aware of would have tracked historically. What did the UK say about tracking of these DTL recapture accounts?
Well, I'm going to go for the pragmatic card again here. We said, just go and read the clear 30-odd pages of guidance that is in the administrative guidance that applies those rules. So, yeah, we are following the OECD rules, as you say. Is it simplicity? Oh my gosh, no, it is not simple, but it's simpler than what was there before.
Right. And I mean, some of this is like that. That's the trade-off, right, Matt? As taxpayers want additional guidance because it gives them some specific things to do with respect to any of these provisions. Generally, that is going to mean complexity, but at least it gives taxpayers a prescriptive rule to be able to apply, as opposed to kind of being in the uncertain area.
That's it. It's a set of processes and procedures that companies can follow to the extent they have to track those deferred tax liability recaptures.
So what did it say about the allocation of profits of flow-through entities?
Again, here we are following the OECD June administrative guidance that the UK rules had actually introduced a different way of allocating those profits, essentially pushing those profits up to the entity that they flowed through to, but now we've adopted the OECD approach generally of pushing down taxes and the reference entity approach that they have in there. And
I think that might have been one of the areas we highlighted as a difference.
We did.
In one of our prior podcast, and so now this puts the UK in alignment with that. Were there any changes, Matt, to the allocation of domestic top-up tax liabilities?
Yeah. So here it's just giving some certainty as to which companies actually pay the top-up tax. And so you essentially look at each individual company in the UK. If their Pillar 2 effective tax rate is below 15%, then that company is subject to a top-up. To the extent it's over 15%, then it doesn't have part of the UK's top-up tax allocated to it.
So, Matt, a lot of questions that we get are with respect to the globe reorganization rules as companies think about deals and restructurings, post-deal integrations. What insight did the UK provide us on the globe reorganization rules?
So, before saying exactly what the UK's done, I think just expanding on what you said, the challenge and why we were getting a lot of questions on the globe reorganization rule was that it was the condition C where the tax basis in the acquiring entity, you essentially needed to inherit the tax basis that the transfer raw entity did. So in a cross-border jurisdiction, you needed to have two sets of rules that mirrored each other, which was a rare beast. I did find one, but that was where the tax basis was 0 and it was 0 on the other end. 0 equals 0. Like, I actually found one that worked cross-border. But on the whole, they didn't, because those numbers matching is very rare, as we said. But what's happened in the UK is the rule has been revised such that provided you don't get the basis step up, then that condition can be met. Now, the UK, as I said at the start, has been very much like in lockstep with the inclusive framework in the discussions and not wanting to deviate from those rules. So it may well be kind of foreshadowing what we will see in some of the forthcoming administrative guidance when it arrives, that we do have a relaxation of that condition within the global reorganization rules that really, I think, achieves what it should do from a policy perspective of taxing any basis step-ups that you get. If you don't get a basis step-up, then it should be neutral from a Pillar 2 perspective.
Very helpful. Matt, what did the legislation say about the treatment of prior year adjustments and rising in respect of the pre-globe periods? Because we know that oftentimes we can have post-period transfer pricing adjustments that sometimes carry over a number of years.
So here it was broadly aligning it with the accounting. So it's you're taking it into account for Pillar 2 purposes, even though it's pre-Pillar 2.
Okay, were there any changes? And this is something I think that's probably most relevant, particularly in the financial services and fund industry, but there were some changes to the definition of flow-through entities. And what did those say?
So there was an issue here with the UK rules that flow-through entities could still be nowhere entities, which basically meant that the UTPR could be applied with, say, a US flow-through entity at the top. Now, wherever the entity is created is where it is located, and thus removing that problem and bringing the UK in line with the OECD model rules and administrative guidance.
Yeah, and that feels like, well, I think we'll end it there and going through some of those particular provisions. I do have a couple other questions, but the theme to me there is many of these are bringing this in line with the OECD approach. And so I think we had a lot of questions in prior podcasts on the UK, but certainly plenty of things to keep an eye on. And with more administrative guidance coming, we'll keep an eye on that. There were two other pieces from the legislation that are relevant for international tax practitioners that were in the finance bill outside of Pillar 2. First one is the ORIP. What did they say about the ORIP?
So yeah, the ORIP, the offshore receipts in respect of intellectual property, where we would essentially levy tax to the extent that you had IP in like a low tax, zero tax jurisdiction, redundant as a consequence of Pillar 2 rules. And therefore, we have repealed our ORIP rules.
I want to congratulate the UK policymakers for repealing a rule that is now redundant as a result of the Pillar 2 rules. I am fascinated to see whether the EU and other jurisdictions take a similar approach. But I think that's really the big news, is that the UK looked, they said, all right, this is no longer relevant because Pillar 2, and let's repeal it. And I think that's a big challenge for many policymakers of just not repealing stuff. It's just layer after layer of paint.
Absolutely. It was a great first step. I think several more steps are required. One would say there are other provisions that are redundant post Pillar 2, but it's a step in the right direction.
I'll start with the CFC rules that are within the UK, but that maybe we can save that for a second for another podcast. And then the other one, Matt, that was with respect to Pillar 1 and DSTs.
Okay, yep. So we did have an announcement on Pillar 1 and DSTs. On Pillar 1, it's that we are just following the international dialogue on Pillar 1, and to the extent we get global consensus, we will follow that and introduce the rules. Then in relation to DSTs, it was another, I guess, a comment in relation to simplicity, that once we have introduced Pillar 1, we will remove DST.
Can I make a bold prediction, Matt?
You can.
That these DSTs are going to be sticking around?
I think they might be around for a little while.
And I think I might have pronounced even the death of Pillar 1 on my podcast with Rohit, talking about the U.S. election results. But we won't be waiting around for the UK to repeal its DST after Pillar 1 Amount A is introduced.
Indeed.
So maybe to close things, Matt, what's next for the UK and Pillar 2? We know we've got some additional administrative guidance. What are you, in your view, for policymakers and just in general and taxpayers? What's next?
I think it's just there's just more ongoing developments in relation to Pillar 2. We've touched on it through the podcast. There'll be more administrative guidance, which will then require more changes to the legislation. And just tracking, like, you have that optionality to choose whether rules apply in 24 or 25 and say there's a need for modelling, a need for tracking, and there's very much a watch this space as to the administrative guidance we get and how it develops. And I think actually through the finance bill process, there's some things that we were expecting to see that are in the administrative guidance that Treasury actually said would be in the draft legislation, but we haven't actually seen them yet. So there's a very much a closer term watch this space to see if those provisions appear.
Yeah, I think I'm going to pull on one thread on that point is that taxpayers always welcome the opportunity for elections, right? Because obviously then taxpayers can choose to elect whatever is going to cause them to pay less tax.
Yeah.
But the downside of the election is that it means that you need to do two sets of calculations to determine which one is going to be the most advantageous. And so to that point, it's important to kind of parse through these rules, understand what is retroactive, where companies have the opportunity to elect retroactivity, and then think about what's going to be the best for those particular taxpayers.
Absolutely.
All right. Well, Matt, always great to have you on learning about the UK. I have a feeling this will not be our last Pillar 2 UK podcast.
I think that's pretty clear.
Okay. So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Matt Ryan, PwC UK International Tax and Treasury Network Leader. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.